Welcome to the Morningstar series Market Reaction. I'm Holly Black. With me today is Russ Mould. He's Investment Director at AJ Bell. Hello.
Hello, Holly. How are you?
I'm good.
Good.
So we're talking today about the US Federal Reserve, which has cut interest rates this week for the first time in a decade. What's happened?
I think there are a couple of things that they're thinking about. One, they're clearly under an enormous amount of political pressure from a chap called Donald Trump, who wants cheap money. It's where he comes from. He wants the economy to be buzzing when he gets into a re-election fight in 2020. The second thing the Fed is worrying about is global trade, which is partly, again, a result of the president's policies, and he's stepped up the tariff war with China virtually as we sit here today. And the third thing it's therefore worrying about is the US economy softening. The lagging data, unemployment, really strong. Concurrent data, retail sales, industrial production, factory orders, not bad. Lead indicators, softening, PMI surveys. So you've got quite a mixed picture from the US economy, more mixed than you perhaps might think from the stock market. So looking at those three factors, and Chair Powell has said it's a sort of mid-cycle adjustment to make sure that the wheels stay on.
So sometimes a rate cut comes before a recession, but this one seems a little bit different.
We'll find out, and that's going to be one of the most interesting things, is the stock market and the bond market have latched onto this saying, happy days, more free, more cheap money. Brilliant news, because if interest rates go down, that forces money out of cash because it goes looking for a better return. It stokes economic growth, good for corporate earnings, good for share prices, and that's what the stock market is thinking. However, if the Fed is really frightened of a recession, the market may need to be careful what it wishes for, because in 2001 to 2003, 2007 to 2009, big Fed rate cuts did not stop a recession and did not stop a bear market. So yeah, maybe markets do need to be careful what they wish for.
So the Fed put rates up 4 times last year. Is it going to backpedal on that, or is this a one-off?
Well, before Mr. Powell spoke, when he said mid-cycle adjustment, I'm not promising anything more, the market was actually forecasting 4 rate cuts over the next 12 months. He hasn't given them that bone to chew on, but what he did say was quantitative tightening. He's now stopping that 2 months early at the end of July, basically. So that is QE. The Fed's balance sheet went from $900 billion to $4.5 trillion as it bought all these bonds to depress bond prices and try and get credit flowing. It's now going to stop at about $3.5, $3.6 trillion. So the Fed's balance sheet is never going back to where it came from. That money that it's created is now going to stay with us, or the vast majority of it, and that's probably why gold is starting to run. Because people are looking, thinking like, hang on a minute, all of this extra cash isn't going away. Maybe when the next recession comes, they're going to go back to QE a lot quicker than we didn't think they'd go back to it all. Maybe they will. And that's when people started thinking, maybe we need to protect ourselves a little bit from more central bank free and easy money.
So I suppose the question is, what does this mean for my investment portfolio?
I think it means a little bit of hedging on your currencies might not be a bad idea, and I think it's interesting that gold has finally broken out of that 1360 range that had capped it for 5 or 6 years. And I think probably, I would think at the moment, because the market's been so excited about rate cuts, I'd actually be a little bit more careful, because if the Fed really does think a recession's coming, stocks are going to look very expensive and there's lots of trouble ahead. If the Fed's going to keep on pumping and keep stocks going, then fine. But I think when everybody's getting very, very excited, you probably need to be a little bit more cautious.
And lastly, and quickly, does this mean the Bank of England's going to cut next? If
you look at the chart of US interest rates against UK interest rates over the last, say, 25 years, where the Fed leads, the Bank of England has generally tended to follow. So it seems a fair bet. However, Mr. Carney this week, as usual, the Governor of the Bank of England, spoke out of both sides of his mouth at the same time, said that, well, we want to raise interest rates because wage growth's picking up and the economy's okay, but we're very frightened of what Brexit could do, and if there's a hard Brexit, we may actually end up cutting interest rates. So I think, understandably, he's hedging his bets, but yeah, he didn't give anybody much guidance at all. But if I was forced to guess, I would say the next move will be down, not up.
Thank you so much for your time.
Pleasure.
And thank you for joining us.